Hello, my dear students. I hope you are doing great. So, yesterday we had started with our Schedule 3. Before going further, we'll quickly revise whatever we had learned. So, our Schedule 3 is given in Companies Act 2013. It is basically the format in which companies have to present their financial statements, basically the balance sheet and the SOPL. We had started with the balance sheet, very basic things we had seen. So first of all, there were general instructions. General instructions while making our balance sheet and our P&L. Also under this, we had one important point about Division 1 that we have in our syllabus. Division 1 applies to those companies to whom accounting standards apply. So we have companies to whom, big companies like listed companies to whom Ind AS apply. They have to follow Division 2 of the Schedule 3. Then we have got NBFCs to whom Ind AS apply. They have to follow Division 3. Division 2 is not in our syllabus, but this is where our syllabus comes in picture. Secondly, in general instruction, what it says that if there is anything which contradicts with Schedule 3, which my Companies Act requires or my accounting standards require, so this schedule says that you follow that accounting standard or law and our schedule will stand modified. So in simple words, law or the accounting standards are above Schedule 3 and according to the treatment, the disclosures, whatever are there you need to do, you do it according to that standard. Okay. Second point says that the disclosure requirements of this schedule are in addition to what my Companies Act requires and my accounting standards require. So simple words, you have to give disclosures under three things. One, under Companies Act. Second, under your Schedule 3. And third, under accounting standards. So this is what. And I had told you that we will see also report of company. Today or tomorrow we'll be seeing actual report of the company where we will see that how many notes are given. So many disclosures are required. Because public have put money in the company. They have a full right to know exactly how your company is running and all the disclosures need to be given for their good decision making. So, ye ho gaya. Then we have got our third point, notes to accounts. So whatever notes are given, the notes we have to see that they are giving description or disaggregation of the amounts. So when I say reserves and surplus, this is one head. Under reserves and surplus, we have so many things like capital reserve, capital redemption reserve, general reserve, revaluation reserve. So that is called disaggregation, right? So notes have to be descriptive. Disaggregation should be given and wherever required information needs to be disclosed in the notes. Also, your notes should not be too much information, confusing the people, too less information, hiding the less information, hiding the things. So it will not be allowed. You should balance it out properly. Okay. Then comes my rounding off provision. Now, what is rounding off provision? In rounding off, you have to see the total income of the company. Total income, as per my P&L, it includes two things: revenue from operations and other income. And this total income is less than 100 crores, then you will have to round off to the nearest hundreds, thousands, lakhs or millions, right? But if it is 100 crore and above, then it will be millions and crores we have and lakhs, millions and crores. Okay, that is how it is. Whatever you use, you have to use uniformly throughout. Means if I'm doing my balance sheet in crores, I cannot do my P&L in lakhs. Not allowed. My notes, my balance sheet, P&L, cash flow, everything should be in one single rounding off point. Okay. So uniform, I mean. Next, fifth point says that whenever you're giving current year figures, you have to give previous year figures also. That is, corresponding comparatives are compulsory. And last point is whatever terms are used in my Schedule 3 have the same meaning or definition as per my accounting standards. Like related parties, leases, what it means, what do you mean by, let's say property, plant, equipment, intangibles, what do they mean? Everything is defined under my accounting standards. We are going to learn all of them. So like that. And remember, this schedule is the minimum requirement which is given. So if anything extra needs to be given, additional subheadings you want to give, or you want to give additional disclosures, you can give that. For example, let me give you an example. Many companies want to give We call this as the EBITDA. Earnings before interest and tax, depreciation and amortization. So if you want to give these kind of earnings, this is not given in my P&L, actual in the format, it is not given. But you want to give that, you can give that, no problem. Okay, you want to give your profit before interest and tax, you can give that. Depends. So this is exactly what it is, up to you if you want to give additional. So you can't get lesser, but you can give more. Also depends on the context. So little bit you can say my schedule is flexible to that extent. Okay, so I hope this is clear now. Going further, the balance sheet format. So we start with balance sheet as at a particular date. You know, my balance sheet is always on a particular date and my P&L is for a particular period. So here we have two parts, equity, liabilities, and next we have assets. Under equity and liabilities, what do we have? We have got mainly four heads. Okay, repeat with me. You have to say it with me. I am not saying it for me, I am saying it for you. So come on, repeat with me. तो चलो सबसे पहले we have got our shareholders funds. Now shareholders funds means what belongs to the shareholder? So mainly three things belong to them: share capital, reserves and surplus, and money received against share warrants. Basically we have got three things here. Then after shareholders we have got one extra special head, sampa we call it, that is share application money pending allotment. It is still not allotted, so it could go up or it could come down. Right now it is a sandwich. Go up means it will become shareholders funds, or it will go down, it will become liability refundable. So it will be coming here. Third, NCL, non-current liabilities. Four heads, LDOL. L, your long-term borrowings. D, deferred tax liability. O, other non-current or other long-term liabilities. And fourth, we have provisions, long-term provisions. Okay. So today we'll be discussing one by one all this in detail. Okay. So today it's going to be very, very important. Then we have got stop. Stop what? Current liabilities. So four current liabilities. One we have S, that is short-term borrowings. T, trade payables, like my creditors and bills payable. O stands for what? O stands for again others. And P is your short-term provisions, like provision for tax will be coming here. Short-term any provisions, you have to any kind of provision for tax mainly, that will be a provision for your employee benefits, etc. will be coming here. The short-term ones. Okay. Then going further, assets, what we have? Only two main heads, NCA and CA. Non-current assets. Now non-current assets may we have got five things. P and DLO. P and DLO means what? P, PPE and intangibles. Under that we have got our PPE, then intangibles. Our capital work in progress means those PPE which are getting ready. And then we have intangible assets under development. Okay. So we'll be seeing the balance sheets and all, actually how this is presented. Then N we have got is non-current investments, long-term investments. PND, deferred tax asset. L we have got is long-term loans and advances. When we give loans or we have given an advance, it will be coming here. And O we have got other non-current assets, right? So these are all the things we have in our non-current asset. And then comes my current asset. Current asset mein what I'll have? CIT, CSO. Cash and cash equivalents. Current investments. C, first investments. Then inventory. Then T comes for my trade receivables. Then again C for cash and cash equivalents. Then S we have for short-term loans and advances. And O, our favorite, other current assets. And then after this, the notes are given. See what is given there? C, accompanying notes. The notes, now what is given, we have to see that in detail. Again, before doing that, the last thing we had learnt was about when is an asset a current asset. Very, very important. So asset will be current asset if any of the four conditions are satisfied. Number one, it is expected to be realized. You will realize it. Okay. Expected. See, everything, the word is expected. It may not actually realize. That's why I'd given you example of finished goods. Maybe it will take time to sell, but at least you expect that you will sell it in normal time. Yes. So when you're making it or you are having raw material, you always assume and expect that you will consume it in the operating cycle, right? But it may happen, it may take time, but at least my expectation is very important. So first, expect it to be realized, or expected to be sold, or it is expected to be consumed in the normal operating cycle. What is operating cycle? Operating cycle is when it starts with your acquiring your assets for consumption, processing, and realizing it into cash. So it includes certain things. What are certain things which are included? Here we have. Let's see. Raw material holding period, right? So holding the raw material, then you're making WIP holding that. Then at the same time, you have got some packing material which is there, which again holding period. Now goods are packed and ready. Now it is being held as finished goods. And finally, then we sell it and the debtors collection period. So all this is there. So if you will see, कि raw material holding period isn't this only, no? So it is like if now a company is something, let's say it's a wine making company, wine. So in that case, what will happen? Automatically, it will have a long period. Wine can take even 2 years, 3 years to make. So then automatically the operating cycle becomes big. And therefore, even if something is receivable in 3 years in that company, it will be current. Depends on the operating cycle. Okay. So there are some businesses having no short operating cycle, some have a long one. And if nothing is given, we take it as 12 months. Okay. So this is operating cycle. And if a company has multiple business, you will have to calculate separate operating cycles for each one. Correct? So we have taken a few examples, and today we have got actual sums. These were simple examples. Now we have got actual sums today we'll see for this. And lastly, it is held for the purpose of being traded. So the whole purpose only was to trade it. Means you want to sell it. Like stock and trade. Then it will always be current asset. Okay. Then it is expected to be realized within 12 months. I told you A and C look same, but there is a big difference in that. A starts from the day you acquire the thing or it is receivable, the date. And C, we will look at that point at the end of balance sheet date. On balance sheet date, within 12 months, what is expected? Okay? In both words, it is expected. Exactly, we cannot say. Okay? Because anything, bad dates can happen, a loss can happen, we don't know, na? But at least expectation. So within 12 months of the year end, if there is anything receivable, we call it a current asset. Okay, so don't bother, it is very easy. I had told you, if there is something like debtors or bills receivable, then you always see operating cycle or 12 months. It becomes easier to understand. Okay, and lastly, it is cash or cash equivalent. Okay, what is cash equivalent? AS3 we will learn. Okay, same book, chapter number 4, cash flow statement, we will learn that. But normally speaking, if you have cash and that cash is available, it can be available in the sense, now what is restriction? Then now let's take an example. It is restricted from being exchanged. I'll give a very simple example for restriction on cash. You must be knowing that when a company declares dividend, it's an example. So if you want, you can write it in D point. It is for that exception example, exception. Okay. A company is there. Now this company has declared dividend. So within 30 days, the dividend has to be paid. By chance, you're not able to pay in 30 days, right? Or some reason it was not the person, you could not find out who you have to pay dividend, whatever happened. Then you have to wait for like 7 days and then transfer it to a separate bank account. This whole dividend, whatever amount was unpaid. So you have to pass it to a separate bank account. Means bank account may I have that amount. But can I use it wherever I want? I cannot. 7 years that amount will lie in that thing. It will lie in that account. Because 7 years I cannot pay it. 7 years I have to wait. After 7 years, if nobody claims, it will be transferred to Investor Education Protection Fund of the government. Means bank may balance is there, but I cannot use that. It's a separate bank account. So it is restricted from use. So then in that case, I will be doing what? I will be showing this as a cash and cash equivalent. No, I will show it as like, it is restricted. It is restricted from being exchanged. So I will show it separately. Are you clear? So this could be an example. And any of this happens current asset, it does not happen non-current. So this is what we have. I hope everything is clear. We have quickly revised whatever we have learned. And now we will today start with a lot of things. First we'll see what is liabilities, current liabilities, non-current liabilities, see some sums, then balance sheet, everything one by one in detail now we will be seeing. So now, coming to our liabilities. What does it say? When will a liability be classified as current? We know now liabilities are non-current and current. So first we will see what will classify as current, and then which is not coming under current will come under non-current. So let's see what they say. First of all, a liability shall be classified as current when it satisfies any of the following criteria. Same like my current asset, any of the following criteria. 1. You are expected to settle it within the normal operating cycle. So same like that. So you are expecting that it will be settled in your normal operating cycle. Your normal operating cycle can be 6 months, 12 months, 18 months, 24 months, even 2 years, 3 years, 4 years. We never know, because it depends on business to business. So if it is expected to be settled in the normal operating cycle, then it is current. Okay. Or it is held primarily for being traded. So now let us take examples for that. Okay, the first one I have to be settled in the operating cycle. We can have example of maybe creditors, bills payable. That could be there. When held for the purpose of being traded. Now assets for being traded I can understand. Yeah, I want to sell the asset. But liabilities for being traded, little difficult to understand, right? How can a liability be for trading purpose? So for that, there is a concept which we call derivatives. It is a CA final concept. Okay. What are these derivatives? Short may I'll have to explain it to you because it is an example we have. So what are derivatives? Let's take one example. Derivatives, this word comes from the word derive. Okay. Your contract is deriving value from a specific underlying asset. Means what? Like let's say there is a future, forward, options. These are the types of derivatives which are there. It is little CA final level, but I'll try to explain it in simple words. Okay, so what happens? Suppose I enter into a contract with you. Okay, so I enter into a contract that in the future, after 3 months, I will be buying something from you, let's say at 100 rupees. So it is not actual buying. It is a contract. It is a derivative that I will buy a certain quantity of, let's say, gold or something from you at 100 rupees. 100 rupees gold is not a good example because how can gold come for 100? But for understanding sake. So it is 100 rupees. Means what? Ki in the future, whatever after 3 months, we will see what is the exact rate. Now that exact rate which is there, we'll see and accordingly we will settle it. So I said I will buy it you from 100 and actually the rate of that item, okay, that item's rate becomes 105. But we had already agreed that I will buy at 100 from you. Our rate has become 105, so I am getting it at 5 rupees less now today. So the 5 rupees less is like the profit which I have. So it's not that actually you will sell me the goods, actually I will give you money of 100 rupees. No, it is like simple. This is 105 rupees. We had agreed if 100 rupees we will buy this at, I will buy it. So I will buy it at like that rate. So 5 rupees my profit you will pay me. So the actual value of our contract depends on this underlying item. Okay. Suppose the value of that item comes down to 90 rupees after 3 months. Now it is like a betting we have done. It's a betting based on this. It's a bet. Okay, speculation type. So now if the item comes down to 90 rupees, but I to said I will buy it now 500 rupees from you. So that means I will have to pay you 10 rupees now, your profit. So in both cases, we are settling it net. Either I'm getting 5 or either I'm paying you 10. So this is purely speculation. Now this can be a liability also for me. This can be an asset also for me. If I make a profit, it will be like a gain, receivable. But if it is a liability, it is payable. A payable, so that means it is coming under liability now. And it is mainly for the purpose of trading. This I'm doing is betting, right? So this will be coming as a example for your current liability. Okay, so this is one example. You will not get this much in your inter, but just little bit knowledge sake I gave you. Third one, very expected. It is due to be settled within 12 months after the reporting date. So within 12 months, if you are expecting to pay it, it is due to be settled. Example, we have got, let's say, loans. What could be loans? Loans which are payable within 12 months, we will show it as current. And loans which are payable after 12 months, we will be showing it as non-current. Okay. So it is possible that, in case of loans, short-term loans which are there or outstanding expenses which are there, we are expecting that, we will have to pay it within 12 months. So yes, we will show it over here. Payable within 12 months. Now loans can be long-term, loans can be current, both possible. So we will see examples for this also. So it could be coming here. Also, company, the last one. The company does not have an unconditional right to defer. Defer means postpone the settlement of the liability for at least 12 months after the reporting date. So simple words may, I can postpone the liability, payment liability, but I can't postpone it more than 12 months after. Means other words may, I will have to pay it today only, it is within 12 months payable, right? So then in that case it becomes your current liability. Now you might think C and D to same, it is looking like same. No, it is not the same. In C and D what happens, D may, you have the right to postpone it, but you can't postpone it beyond this. But in C point we are clearly saying that you have to settle it within 12 months. It is payable within 12 months, we know that. Here you can postpone it, but at the same time you cannot postpone it beyond 12 months. So if there is something which you can postpone afterwards beyond 12 months, now these kind of contracts could be there. We have to see the contract and see. So there is a liability payable, but the company has an option of paying it off. They can postpone it 1 year, 2 years, 3 years according to the contract. Then it will not be current liability because you have the right to defer it. But if you don't have the right to defer it, it is payable as per your contract. So you will show it as a current liability. Okay. Also, the liability terms, this is very interesting, which at the option of the counterparty means the option of the other party, result in settlement by issue of equity shares, this will not affect its classification. Now what does this mean? So for this we have to understand the example. Write down example first. Convertible debentures. Convertible debentures into bracket convertible at option of holder. Convertible at option of holder. So chalo, I'll explain this to you, okay? We all know what are convertible debentures. Convertible debentures means we are going to convert them into shares, right? Now convertible debentures, there could be an option. Option is either with the company. Company has got the option कि we can convert it later on. We want to convert it, we will convert it. We don't want to convert it, we will give you cash. This is at the option of the company. Okay. So this is one thing. And second is if it is at the option of the debenture holder. Debenture holder has the choice कि they want to convert to shares or they want cash. This is the thing. So now the question comes, where should the company and how should the company show it? So in this case, now understand. We can continue with this only examples list, okay? 6 examples, and I'll give you some liability examples. I'll give you some liability examples. 7th example, okay? I will explain the convertible debentures. One or two more examples we'll take, then I will go for it, okay? So 7th one now what we have. Example, creditors. Creditors payment period. We are continuing with the list of examples. In that only I will tell you about convertible debentures, okay? So creditors payment period, let's say it is 6 months. And company's operating cycle is 9 months. So now the question is, what should we show this as, current or non-current? So let's say the payment is expected in 6 months, in 10 months, or let's say 12 months, 14 months. What do you think? So now we are expecting to pay within 6 months or within 10 months. 6 months means what it will be? It will be a current liability within normal operating cycle. You can even say within your 12 months from the reporting period, but fine, 6 months here. This 12 months and this 10 months, both will be current liability. Why? Because it is within 12 months of reporting date, of balance sheet date. So on balance sheet date, I have to see when I'm expecting I will pay it. If it is due, it is payable now within 12 months, it is come here. But if it is payable 14 months later, expected to be paid after 14 months, then it will be non-current liability, as it is beyond 12 months, of reporting date. I hope you understood this. Simple. Next, one more example. Eighth example. Company has a outstanding loan of 50 lakh. Has an outstanding loan of 50 lakh. Rupees 3 lakh is payable by 31st March 24. You write this outstanding loan of 50 lakh on 31st March 23. And 33 lakh is payable by 2024. So now how will you show this? You will show this like this. How will you show it? So how will the loan be shown? The loan will be divided in two parts. Right? The 3 lakh which is there, which is payable within 12 months of balance sheet date. This you will show as current liability. Okay, and what will you show this as current liability? Where will you show it? So this is shown under short-term borrowings. So short-term borrowings we had short-term borrowings. So we show it under that, and this we show it as a It is called current maturity of long-term loans. Means the loan is actually long term, but what is payable now? What is payable within 12 months? We call it current maturity of long-term loans, and we show it there. So we are having one hand, it is shown as current liability. See, first we have to understand, is it current, is it non-current? Then we have to understand where it will be shown. And then we have to understand what is the name, under what it will be shown. Okay. So what I'm saying now, first we understood loan is there, payable within 12 months, it is current. Then the question comes, current liabilities mein to we had four heads: stop, short-term borrowing, trade payables, other, and provision. Where will it come? So it will come under short-term borrowings. And short-term borrowings, what will it be called? It will be called current maturity of long-term loans. This is the words. We have to learn this, but now we can start understanding. Okay. So this is what will come. And the remaining amount, what is remaining now? Total 47 lakh. Total 50 lakh, out of that 3 lakh is current. So this will be coming under non-current liabilities. But where will it come under non-current liabilities? It will come under long-term borrowings. Understand? Now I'm not just saying current, non-current. Now I'm taking one step ahead. Where under that? So this is how we will be showing this. I hope you understood this. Yes? Now you might say, one more thing now. Now some companies will say, Are, though I have an outstanding loan, I can't pay it. I know I am having problem. I don't have money to pay. So I will not be paying. They might say that. Right? So they will say it is not a current, it is not a non-current liability. It is a long-term loan. But let's say the 3 lakh rupees I don't have money to pay, I will not be able to pay. Are, you will not be able to pay is not the point. It is due to be paid. And you don't have any right to defer it. It is payable. You will pay, you will not pay is a different story. Understand? You might default in the loan, but that doesn't change the classification. It is payable, it is current liability. You default, that's a different story. So people or students have that doubt in mind. They may not pay. They may not pay is not the point. It is payable, that is the point. Okay. So understand, this is how the loan will be shown. Take one more example now. Ninth example. Okay. Let's say you have outstanding debentures. You have debentures. Why outstanding? We'll call it just debentures. Debentures of rupees 1 crore on 31st March 23. They are payable after 5 years. Payable after 5 years. Okay? Then in that case, what will it be? Of course, it will be non-current liabilities. Again, under long-term borrowings. You will show them because it's payable after 12 months, so it will be a non-current liability. Out of that, if some debentures are payable now, like point number 8, it is redeemable in parts. So fair enough, then you will show it as a current liability, that much portion, then remaining will be non-current. You might have a question, what about interest on that, ma'am? So interest on that, if it is payable within, interest is accrued, that accrued interest will always be current liability because it is accrued. Every year you're using the money, it is going to be accrued. Okay. So this is how it is. Accrued, payable, accrued, not payable now, but still it is accrued. And any liability is accrued. You don't have a right to defer it. It is accruing. So you will be showing it as a current liability. Okay. So that we will see during the heads that we have. But the next one we have is now the last example of this sort. If you are having convertible debentures issued by company. They are convertible issued by company, right, like this. convertible at option of, convertible at the option of the debenture holder, at the option of the company. Two possibilities may happen. So if they are convertible at the option of the debenture holder, now understand, this is little tricky scenario. They are convertible at the option of the debenture holder. So debenture holder may say give me cash, debenture holder may say give me shares. But debenture holder may say give me cash, right? It is not up to me. It is not up to the company. It is up to the debenture holder. So for company, though, it is a liability, no? Because they can ask cash, correct? So we have to then see ki what is it. We will show it as a liability. We will show it as a liability. If it is the conversion is due in this year, we can show it current liability. If conversion is due later, we will show it non-current liability. Okay, depends on when the conversion is due. But at the same time, understand it is your liability. Because it is a promise, you cannot defer the settlement. Can you defer the payment? Can you defer it? No, you cannot. You cannot postpone it telling the person, no, I will give you later, I will give you. No, you have to pay it now. Right? So it will come as a liability. If they ask shares, then you will not pay cash. But it is up to them. It is not up to you. You don't have the right to defer it. The law says very clearly, Schedule 3, you don't have the right to defer it. They have the right. So that's why for you, if it's not deferable, you don't have the right to do anything, you will show it as a liability. That is what that point says. One step ahead now I will go and I will say, now what if the company is having the choice? They can give shares or they can give cash. Then what will you do? Then this is CA final level knowledge, but little bit again I will give you because it is required here. In this case, this will be called as a compound instrument. Compound instrument means what? It is a mix of compound means mix of something, right? It is two things mixed up. So this is a compound instrument. It consists of liability and equity. Both are there. Some portion of it is a liability. So what is like a liability key? What if I pay in cash? What will be the amount payable? That amount you show liability. So this will be calculated. How much is the amount payable? And this will be calculated by calculating present value. It's a procedure, long procedure. But just to understand, it will be calculated and equity will be the balancing amount, balancing figure. So for example, your debentures are of 1 crore, your debentures. After calculation of the liability, it comes to 90 lakh. How liability is calculated, ma'am? That we will learn in CA final. But right now, there is a present value calculated. That 90 lakh will be shown liability and remaining will be shown equity. So 10 lakh will be the equity. Okay, so this will be the balancing figure. But this is purely your CA final. I'll write here so that you don't get confused. Okay, but I'm just giving you knowledge. So I hope now this is clear ki what is a current, non-current liability. Okay. So this, I think it's pretty much understandable. See, Schedule 3 now you can get a 5-mark question in terms of theory, like, what is it? Where will you show it? Those kind of things. But when we will do big sums of 20 marks, that time it will not matter only these things. They will just write debentures, we will put it over there. We will not bother about it. We'll just call it as a liability only. I'm telling you in the big sums what will happen, okay? So now this is clear. Coming back to the theory part. All other liabilities, if it doesn't fall under this, then all other liabilities will be shown as non-current. So first you see, is it current? No, it is not current, then it is non-current. Okay. Then point number 4, a receivable will be called a trade receivable. Trade receivable means it is receivable in the normal course of business. It's the amount which is due for goods sold or services in the normal course of business. So let's say you are a company which is dealing in pharmaceuticals. You're a pharmaceutical company. So whatever amount is due in for giving the goods to your distributors and all the medicines and all. So that will be in the normal course of your business. Your main business is selling medicines, manufacturing and selling medicine. So in that case, all that will be shown as trade receivable. Hmm? But anything other than that, for example, now there could be a loan given. Now loan giving is not your main normal course of business. That will not be shown under trade receivable. It will be shown loan receivable. You have given an advance for something. It is not normal course of business. It will be shown as loans and advances. Normal course of business, what you do, that will be coming under your trade receivable. So we have got our debtors and bills receivable. This is normal course of business. Okay, so we put it under trade receivables. And what is not normal course of business? Loans given, other things, outstanding receivable. We're talking to prepaid expenses. Now, what is prepaid expense? It is not normal course of business. It will come under others. It will not come under trade receivable. Similarly, you have got a payable, which is payable in your normal course of business for goods purchased or services rendered. All of that will be trade payable. Again, example, creditors and bills payable. This is your normal course of business. And then company will disclose the following notes. So now they are saying about the different notes which need to be given in your financial statement. So notes may we have so many things. Share capital note, reserves note. Now we have to understand all those one by one. But before doing that, we will do some sums on this concept. Which concept? This payables and all. We'll finish that concept first and then we will go to the sums. Okay? I mean this notes and then the sums. So we will little bit juggle between theory and sums, otherwise it will become very much theory, okay? So now let us go to our problems. So now come to your problem number 3. Problem number 3. You are requested to calculate the operating cycle. We have already done this sum, okay? The operating cycle, how will you calculate? You know, raw material holding period, WIP, finished goods and debtors collection. So we have to take the total. So this total is coming how much? This total is coming 14 months, right? So 14 months is your operating cycle. Simple. Problem number 4 asks you, in the above example, what would happen if the trade payables are paid within 12.5 months? So normally 12.5 months we are paying them. So in that case, what will it be, current or non-current? Current liabilities, because they are payable within the normal operating cycle. So here I don't need to see 12 months. I know it is within my normal operating cycle. So finish. It is expected to be settled within 12.5 months. Therefore, show as current liability. Easy? Okay. Next one. Problem number 5. H Limited. See, when we are reading a problem, okay? So while reading only what is important, you should underline that, so that you get exactly, then when you are answering, you know where to focus. So H is engaged in the business of manufacturing wine. The process of manufacturing wine takes 18 months. So clearly they are saying it takes 18 months. So I know what this question is going to take me to, right? It takes 18 months. Due to this reason, they have prepared the FS considering operating cycle 18 months. And the raw material purchased held for less than 18 months is shown as a current asset. So normally we expect to use this inventory within 18 months. Means I'm expecting to use my inventory within the normal operating cycle. So is it correct what they have done? They are showing it as current asset. 18 months may they are going to use it. Still is it current? Yes. Why? Because it is within normal operating cycle. Operating cycle can be 2 years, 3 years also. No problem. Depends on your business. Right? Hmm. So like you are having this, you are making inventory or something which takes a long time to get ready. Let's say you're making heavy machinery, heavy plant and machinery equipment you're making. It can take 4 years also. Then that can also be current depending on the operating cycle. So every business can have a different one. So yes, this is correct. So how will we answer this? We will answer this like as per schedule 3. What does schedule 3 say? As per schedule 3, an asset is a current asset if it is expected to be realized in the normal course of in the operating cycle or intended for sale or consumption in the normal operating cycle. Also, what is an operating cycle? It is the time between acquiring an asset for processing and realizing it in cash or cash equivalents. When you can't identify, though if operating cycle cannot be identified, we assume it 12 months. But here we can identify. It is given 18 months. So here it takes 18 months. Therefore, the normal operating cycle is 18 months. So company is correct. Company is correct that the operating cycle is 18 months and not 12 months. So what they have done is proper. The material purchased and held in stock is current asset. They will show it as current only. Okay. Also one more thing, during this whole in this entire book, entire notes, everywhere in between, I've put these small quotes, motivational quotes, or I would say you know uh, sometimes small jokes around, just to lighten the thing. Okay, so you can always read this. Like for here it's written, the beautiful thing about learning is that no one can take it away from you. So it's such a inspiring thing, right? So when you're learning for life. So always remember this. So these small things I've put around the way is just for to motivate you or just to inspire you. So definitely read that also. Okay. Anyways, coming to the point, see how the answer is given. Answer is given how? First we explain what schedule 3 says, what is current. Then we explain the operating cycle. Then we said if operating cycle is not given to 12 months, but here it is 18 months given. And because it is within the operating cycle, it is a current asset. So what company has done is correct. So same thing. What was written in the question only I pick up from their points and explain it in my answer. Okay. So easy one. Come on. Problem number 6. Now this is a ICI study material. MTB October 20 exam question. I mean, it has come in your mock test paper. So read carefully, then we will discuss it. You will read it yourself. Come on. So first step, you will see it's a asset or liability. First understand that. Second step, if it is like here, they have taken a loan from bank. So loan from bank, liability. Understood. First, that step. Second step, is it current or non-current? Then we will see that. And whatever it is, then where will you show it? So how do the steps go? First step, what we will see? First step, we are going to see step 1. Is it an asset or a liability? Step 1. Asset or liability? This is the first question you will ask. Step 2. After knowing it is a liability, it will be current or non-current. This is my second step. Step 3. Which head, under current or non-current, we have got now? So if it's, for example, in this case, if it is a non-current liability, then we will see, is it coming under L, D, O or L? If it is a current liability, then we will see, is it coming under stop? Long-term deferred tax liability, others, long-term provisions, short-term borrowings, or trade payables, others, or short-term provisions, depends. And then step 4, last one, any other disclosures, or what is the heading it will come under, which head, so we know which head and subhead you will be seeing over here. And any other points will be step number 4. Okay, so you have to first understand what it is, then which head, and then which, or under what. Like even in long-term borrowings, what will you show it as? That you will give. So in this sum, now let me see what they are saying. They took a loan from bank for 10 lakh. Okay, so loan taken is 10 lakh. To be settled within 5 years in 10 equal half yearly installments with interest. Okay, so half yearly installments, 10. So that means 10 installments, 10 lakh divided by 10, 1 lakh every half year, every 6 months, 1 lakh payable. Correct? Okay. First installment is due on 30th September 1 of 1 lakh. How will the amount be shown in your financials for the year ended 31st March 2001? Right? So now 31st March 1. How much will you show? Okay. So we know 30th September 1 installment will come. 31st March second installment will come. Correct? Right? 2 installments will happen within 12 months. So on 31st March, we will show current liabilities of 2 installments. Which 2 installments? 30th September 1 and 31st March 2. These 2 installments I will be showing as my current liability. So first I decided it is a liability. Second, I decided it is a current liability and the balance amount will be non-current. Total 10 lakh na loan is. So 2 lakh is current, so remaining is non-current. 8 lakh will be balance amount. Write the balance amount. You can write in your notebook also. Write in your notebook if you want, okay? So this will be the balancing amount. Total 10 lakh, out of which 2 lakh, 8 lakh like this. And how will you show this? How? You will show this under current liabilities, under short-term borrowings, right? As long-term maturities, current maturities of long-term borrowing, maturities of long-term borrowings. We took one example, same type. Okay, and the remaining 8 lakh you will show under non-current liabilities, under long-term borrowings. Is it simple? Understood? Important question. Star mark. Clear. So we'll see answer mein what we are saying. Installments due on September 1 and March 2 will be shown under short-term borrowings as current maturities of long-term debt, and the remaining 8 lakh will be shown under long-term borrowings. So what about the interest? So interest will be shown as a payable under current liabilities only. Okay. They're saying with interest now. So interest amount will be shown under current liabilities. Okay. Problem number 7. On 1st April 3, Charming Limited issued 1 lakh 10% bonds for 10 lakh rupees. So they have issued bonds. So when we issue bond, it is liability, like bond debentures issued. On 1st April each year, 1st April each year, interest is payable on the amount outstanding. So first amount will be paid on 1st April 4. On 1st April each year, they also have an obligation to redeem 10,000 bonds at rupees 10 per bond. How should be this presented in the FS? So 31st March 24. 31st March X4 means we consider it, you can just call it 4, you can call it 24, you can call it 34. It is just an X. Okay. So 31st March 4. How will you show this? This is the question. So there are two things now which are payable. One is going to be the interest. So 31st March 4, if I will see, I have to be paying interest on 1st April 4. That is payable. Plus, we have to pay the principal also. Amount payable or redeemable. How much is that? 10,000 into 10 rupees. So 1 lakh, no? So interest will be for 1 year. 1st April 3 I issued the bonds. 1st April 4. Matlab interest is 1 year. So 1 year interest will be 8% of 10 lakh. Correct? So 80,000 interest. The amount redeemable is 1 year you have used the money. The full year you have to pay interest. Okay. So now how will you show this? Right. So this is the understanding. Now you can write this in your notebook for better presentation. We'll write it in the notebook. Okay. So what you will do, you will divide the amount separately. So first we have got, we decided that, right? The debentures amount, we'll divide it in two parts. This is 31st March 4. The current maturity, debenture nahi, bonds hai na, they are bonds I guess, right? Debentures nahi, they are bonds. Write the bonds. Current maturity of your long-term borrowings or long-term debt. So we saw 1 lakh is payable within 1 year, and the remaining, the balance amount will be 9 lakh. So how will you show this? This will be shown under your short-term borrowings. and this will be shown under long term borrowings. Easy? This is your current liability, this is your non current liability. Plus we have interest also, correct? So first we have this, and second we are having the interest on bonds. It is 8% of 10 lakh. So 80,000 where will we show? Under your current liabilities. You can show them under other current liabilities. Interest we don't show under borrowings. Normally interest we will show under other current liabilities. Okay. I hope this is done. Yes. Then next one what we have. Chalo, same sum. One step ahead we will go. One step extra. What will happen on 31st March year ending? Now whenever I do something extra or I'm giving you something more, so I call it CU point. CU point means what? It means conceptual understanding. So my answer is over, but I want to understand more concepts. One step more I want to do. So what I do in my CU point, I understand extra things. For example, CU point in this sum. Next year, 31st March 5. How will things be on 31st March 5? If I want to think, how will I show this? तो अब next year में bonds out of 10 lakh, 1 lakh is already paid now. Right? Last year we paid it. So now 1 lakh will be payable again next year. This will be current liability. Correct? How? This will be which is payable on 1st April 5. For your understanding. Right? And remaining will not be 9 lakh. Now 9 may say already 1 is gone up now. So remaining will be 8 lakh. So total is 9 lakh. And this will be non-current liability, long-term borrowings. Understand, every year 1 lakh you will pay now. Every year 1 lakh they have to pay. Okay. Now interest will be how much? Now interest will be 8% of 9 lakh for this year. Full year you are using 9 lakh and then April 1st you will pay the amount. Na? So full year ka interest you will have to pay. So 72,000 will be the amount of interest. Like this it will happen. Okay, again this will be your current liability. Did you understand this? Very, very important. Now every year 1 lakh will come down. So some amount will be current, some will be non-current, some will be other liability. So you have to understand where things will go. Okay, so this is called conceptual understanding point. And like this CU points, I give you many places. Wherever you have to think little extra, thoda sa aur dimag lagao, understand things better. So you have it like this. Okay, this is not your answer. Answer is over. This is extra understanding. Okay. I hope this is clear. Next one. MTP question. We will have to solve this in your notebook. Okay. See, some answers are given, but still, which are very easy, we will directly see. Which is more thinking, exam oriented, so we will solve it again in the notebook. Problem number 8. Let us understand. From the following info, prepare balance sheet extract along with the notes making compliance of schedule 3. So you have to give schedule 3 requirement in this. Loan funds, two loans are there: secured loans, unsecured loans. Short term from bank. Okay, the short term loans we are having. Other information: secured loan from banks and others. So you have taken some secured loan from bank, some you have taken from others, not from bank, maybe NBFC, other parties, whatever. Hmm? So this is 18 lakh 12,000. This 18 lakh 12,000 they have given me breakup from banks, from others. Okay. And current maturity, what I told you, which is payable in this 1 year. Because when we take a loan, some amount we have to pay now. It is an installment now, so we have to pay some amount now, some amount later. So which is payable within 12 months of balance sheet date, we show it under current maturity. The current maturity of long term loan from bank and from others. So both have been given. There is no interest accrued. No interest is accrued or due at the end of the year. Current maturity of long term loans amounting to 2,09,000 is included in the 18 lakh 12,000. So this total 2,09,000 is included in 18 lakh 12,000. So 1812 mein this amount is already there. So now you need to properly bifurcate and show it. So we will show it, no problem. So chalo, let us understand. First of all, two things will be there. One is going to be long term loans, one is going to be short term. Correct? So here when I have long term loans, I have to see, and the short term borrowings, how much we have to see that. Okay, so one by one let us understand. Write down in your notebook, balance sheet extract. Balance sheet extract. As on, date is not given. Or you can write as at. What is the date? Not given. So we have got particulars in our balance sheet, note number and rupees. This is how normally we will show our balance sheet. Okay. Particulars, note number, rupees. With particulars mein we have got equity, liabilities, assets. Then under equity liabilities we have got our shareholders funds and all that, non-current, current liabilities. So this particulars, under that we have got equity and liabilities. Under equity and liabilities I have got here we have two things now, long term loans and short term loans, both are there. So we write it as non-current liabilities. This is the main heading, non-current liabilities. Under non-current liabilities I have some long-term borrowings. Long-term borrowings, which will be note number 1. Leave a line, write down then current liabilities. Current liabilities mein I have some short-term borrowings. Though what do you have, that current maturity is shown there only now. Short-term borrowings. Note number 2. What we have to show like this. Okay. So let's see our notes to accounts. This is it. Now you can write down notes to accounts. Write it after this. I am writing it here, but you write it after this. First one is long-term borrowings. Leave 4 lines and then write down short-term borrowings. See, whenever you have to make balance sheet or profit and loss, normally we first make our format and then we just write the figures there. So let's start now. Okay. Long-term borrowings. What is given first? They have given. What have they given first? Secured loans 18,12,000. 18,12,000 ka breakup is given. If secured loan from bank, secured loan from others, and in that also current maturity is given separately. Correct? So what will I write now? Secured loans. From bank. They have given from bank 18 lakh 12,000. No, from bank is 8,95,000. Inner column 895, and from others you have to give secured loans separately, unsecured loans separately. So we are going to see the breakup, how you have to give things. Okay, but now we are doing current non-current understanding, so we are doing it first. So from others it is 917 less current maturities of long-term debt. Current maturity is given to you 2,09,000. Calculate karo. So 16,03,000 is your long-term borrowings. You write it in your balance sheet extract. So note number 1 and details of that note we have given here. Ab short-term borrowings mein what I have? Point number B, unsecured loan from bank, right? We have an unsecured loan from bank. $2,25,000 given. And current maturities of long-term debt from banks, from others. 1,24,000 inner column 85 and outer column 2,09,000. This total 4,34,000. $4,34,000. So simply speaking, you have full amount, but you just have to break up between current, non-current, show it properly. Okay. 5 marks, important. Now, you can always write in this problem 8 your page number. You can write like this, where you have written this answer. You can always write over here, ki book 1 you have written it. Page number 2, 3, whatever it is, you should write down. So whenever you want to refer it, you always have it there, okay? So you can write like this, book 1, page, say 4, whatever your page number. You can always write like that, 1/4. So you will know okay, what this is, okay? Where this answer is. Okay, that's it. So current, non-current, we have understood. We have some advanced question in this also, but little later we will do. We are finished with operating cycle also now. Yes. So now let us go further. So now we are going to start with the notes to accounts. Now in notes to accounts, what are the details which are needed to be given for everything? See, we had seen that balance sheet, P&L, they have to give cross reference to the notes. That all the information extra needs to be given in the notes. Okay. So like in everything, like share capital, what are the notes to be given? Reserves, what we have to give. All that now one by one we will have to see. Okay. So first of all, starting right from the balance sheet, right on the top, shareholders funds, first item I have is share capital. So in share capital, what I need to give, okay? So what you can do, you can use a highlighter and small points which are there or examples which are there, you can write it in your pen there only in the text itself. So here only you'll have all the information, okay? So first thing, as I'm highlighting, highlight with me. So for share capital, now we know that companies are having two types of share capital, equity share capital, preference share capital. What is preference share capital? Which is payable before the equity. They have got preferential rights. So they are repaid before the equity. In case of they are redeemable. That means they will be repaid later on. They are even in case of liquidation, they will be paid off first. And even for dividend, we will be paying them first and then the equity. So they are called preference shares because they are having preference over the equity shareholders. Okay. So for each class of shares, so what are the each class of shares that we have? We have got mainly two classes of shares. For each class of shares, we have to give the different classes, like whether it is equity, preference, we need to treat separately, show it separately. Now in preference shares also we can have participating preference shares, we can have cumulative preference shares. So what are those? Little by little we'll discuss. This is going to be like a revision also, what you have already learnt in your foundation. And if you don't remember, then anyways we will be covering that, okay? So what will you write? First thing you will write the authorized share capital. What is authorized capital? Which has been registered in the memorandum of association, which is registered in with ROC. We have to tell them ki what is our nominal capital, also called authorized capital. Ki maximum company can issue this much of capital. So first we have to write the authorized capital. Then we have to write the issued, subscribed and paid up capital. Issued is what is issued to the public. Subscribed, how much they have subscribed for. Then how much you have called up as a company. And after you have called up, how much have they paid? So all of that comes over here. Okay. So it is the amount of issued shares, then the amount of subscribed shares, and whether fully paid, subscribed but not fully paid, everything needs to be given. So what we do, we write like this. In our share capital, we are going to write like this. We write our equity share capital. Okay. Under that we write authorized, so many equity shares, whatever number of equity shares of rupees, the face value which is there, we write that of rupees this each. We write the amount and then we double underline, because this is only authorized, it is not in the books of accounts, it is only for the disclosure sake. And then we write issued, subscribed and paid up. issued, subscribed and paid up. So then whatever is the amount of shares we will write over here. So whatever amount of shares are there, let's say 1 lakh shares of rupees 10 each. Okay, we will write in the inner column. Suppose 10 lakh. Out of that, some amount is not paid. You know, na, some people don't pay the shares, the call money. See, when shares are issued, there we have got application money, then we have got allotment money, then we have got call money. So some people don't make the payments. So if they don't make the payments, then that is your unpaid amount. Okay. So less we can write here calls in arrears. Calls in arrears means which has not been paid. We have called but they haven't paid. So for example, this is only an example we are showing. For example, 10,000 is in arrears. So we will write 10. So when I will see the called up capital is 10 lakh. Out of that arrears is 10,000. So remaining 9 lakh 90,000 it becomes the paid up capital. So this is how we show the things. Okay. So normally equity shares we show this. This is the main thing which we show. Then if you will see, we just said na par value. Par value means face value of the shares. Market price is different. Market price is what is going on in the market. Market price does not come anywhere in the books. Always it is the issue price which comes here. Okay. And share capital is always on the face value. Suppose 10 rupees share you are issuing it at say 40 rupees. So 30 rupees extra is your securities premium. That goes in your reserves and surplus. Okay. So this is how it is. So par value. Then you have to also show a reconciliation of the shares outstanding at the beginning of the period and at the end of the period. So what have you done? Have you issued some shares? So we will add opening balance plus issued. If you have done buyback, then we will minus that and we will get the closing balance. So reconciliation needs to be given. Okay. Then we have to give the rights, the preferences, restrictions on the shares, distributions of dividend, repayment of capital. What are the restrictions and everything? For example, you can have participating preference shares. Participating preference shares, or we have got cumulative preference shares. What are these? So participating means they will get extra dividend. When we are giving the equity, they will also get part in the profits. Extra dividend, so they will get normal, plus profit also some percentage they might get. That is their rights with them. Or you have got cumulative preferences. Cumulative means what? Dividend this year we pay, very good. If we don't pay this year, then next year they will get 2 years dividend. They can accumulate the dividend. That's called cumulative preferences. So that gives the kind of things which are there. Then you can have shares with differential rights. You can have equity shares with differential rights. So they have got different voting rights. Means you are holding one share. Normally we consider it as one vote. But it can happen that there is one share which is having 2 votes. Like promoters, these keep these kind of differential shares. Equity shares with differential rights, they are called. Earlier you had this in your syllabus, but now it has gone. Okay. So what are the rights? What are the things which are there? Are they cumulative? Are they participating? Are they convertible preference shares? What exactly? They could be convertible preference shares. Today we saw example ki they could be convertible debentures also. They are convertible debentures means they could become equity shares. So some portion might come here also. It depends on the situation. Okay. How we present it, what we do. So these are the things you have to disclose. Okay. So face value disclosed, issued, subscribed, authorized, disclosed. Then you also have to give the shares held by, again now this is important. Okay. Now this is new also for us. Shares in each class, shares of each class of the company held by its holding company or its ultimate holding company, or shares held by subsidiaries or associates of the holding company or the ultimate holding company in aggregate. Now what does this mean? So for this we have to understand with the help of a simple diagram what is this holding company concept. Okay, so I'll explain this to you. How does this work? Let's say we have a company X Limited. So this company X Limited, what are shares held by? See, whatever point I'm explaining like this, okay, this is point number F. So you write in your notebook point number F. So you will have that reference over there. Share capital point number F, this is the example. So for you it will be easier later on to relate it. And in your textbook also write ki page number so and so. So you can cross reference it. So X Limited is the main company. Okay. This has got a holding company. H Limited. What is this? Holding company. So what is a holding company? Which is holding control in X Limited. Means holding more than 50% of the capital. Share capital if they are holding. More than 50% of the voting rights they are having. Then it is called the holding company. Holding, subsidiary, full AS 21. We have a full chapter of consolidation on this. But right now just understand it is a holding company. Now suppose this holding company has one more holding company. Means H Limited, there is an ultimate holding company. We call it UH Limited. Means what? Ultimate holding company. So ultimate holding company is the main holding company. So for example, let's say Tata Sons. Tata Sons is the ultimate holding capital company of say Tata, any other company. So Tata Sons is the main company. So Tata Sons is having, let's say, in TCS, Tata Consultancy Services. Tata Consultancy Services having another subsidiary, X Limited. So Tata Sons becomes the ultimate holding company. Then we have holding company and then we have X Limited. Okay. So now what we have to report here? What we have to write in the notes? So we have to write in the notes ki how many shares are held by the company's holding company and the ultimate holding company. Not only that, how many shares are held by holding ultimate, including shares held by the subsidiaries or associates. So UH Limited's, there might be some subsidiaries. Other subsidiaries also, na, they might be having, or associates of H Limited or ultimate holding company. So we are talking of 6 parties over here, or associates of H Limited or of ultimate holding limited. So this is what we have to give in the notes. So if you see, we are having like 6 parties we are talking about, right? So how many shares are held by my holding company, my ultimate holding company, and my ultimate holdings and holding company subsidiaries and associates. Okay. So 1, 2, 3, 4, 5 and 6 parties. Okay. Now I'm saying 6 parties, not necessarily 6 companies. My ultimate holding company may have 20 subsidiaries, 30 subsidiaries. So any of them are holding cash shares in X Limited. There could have 100 associates. Associate means what? Associate means normally where we are holding 20% or more of the capital normally. Okay. So when we talk about associates, associates generally means we are holding 20% or more. Okay, 20% or more of the share capital is held. And subsidiaries means it is more than 50% of the capital of the share capital held. In normal sense, okay. Associates, we have more detailed this we will cover in AS 23. What are associates? Similarly, what are subsidiaries and all we will cover in AS 21. We are going to learn this later, but right now because the words have come, we have to understand. Okay. So simple words, what are we trying to say? See the point number F again. The point is saying what? What are the number of shares held by? See, shares of each class in the company held by. So shares held by, shares in X Limited held by 6. You have to give the details. These 6, 1, 2, 3, 4, 5, 6. Okay, so these are the details you have to give. Hmm? So what is the subsidiary? A subsidiary is where we are holding more than 50. Who is an associate? Where the company is holding more than 20. 20 but less than 50 obviously. Less than 50 because more than 50 it becomes a subsidiary. So we are seeing X Limited. Who is holding shares in my company? Holding Ultimate or their associates or their subsidiaries. So we need to give that detail. Okay. Then we also need to give the names of the shareholders. Names of the shareholders who are holding more than 5%. Names of shareholders. Each shareholder holding more than 5% shares. Giving the number of shares. Now you will say 5% shares. How does it matter? Only 5%. No, 5% is not small. When we talk about big companies like listed companies and big companies, you will not believe sometimes so much of public. We think, let's take the example of Tata. We will think in Tata, let's say TCS or Tata Motors, we think that how much public will be there, right? So public means lakhs of shareholders are holding hardly 15-20% shares. Majority of the shareholdings are by the Tata Sons or the holding company. So one person holding more than 5% shares is like a big deal. They are like huge. Okay, and there will be hardly one or two shareholders who are holding more than 5%. Understand that. Okay, so we need to see, and I will show you reports of the companies. After we learn this, I'll show today or tomorrow we'll be seeing the report. So this point also I will show you. So they have to give the number, how many shareholders are holding more than 5% and how many shares are they holding. Okay, so you could have like LIC holds, LIC Life Insurance Corporation holds like more than 5% in Tata or Reliance maybe, so they have to give that. Plus say Mukesh Ambani is holding shares, so we have to give the names of the shareholders, like who is holding more than 5%. Just an example I'm saying. Okay, then also we have to give any shares which are reserved to be issued under options. So basically, if it is an options, like someone is holding an option to buy shares in a company, like ESOP, for example, employee stock option plan. So employees have an option that they can buy the shares of a company. So whatever like these contracts are there, you have to give the details. So for this, you can have like ESOP. Example here, you can have ESOP, employee stock option plan. So this will be whatever number of options they are having, we have to give the details here. Okay, or there could be like convertible debentures, or there could be promoters agreement. Promoters agreement. The promoters have kept the right they can buy the shares if they want later on. A lot of promoters do this. What they do, when they float the company, that time only they give that option to themselves initially. If we want, after 10 years we can buy the company at so and so, or the shares we can buy it at this rate. So it is an option they have. They may buy if they want it after 10 years. So these kind of contracts which are reserved in the share capital, this may become shares in the future. We need to give the disclosures. Okay, even convertible debentures can be there because they could be converted into shares. So you have to give the note. Then for a period of 5 years, immediately preceding your balance sheet date. So if your balance sheet date is 31st March 2024, so 5 years before that means 31st March 2019. From that date till 24, in these last 5 years, as at which the balance sheet date is immediately preceding the date at which balance sheet date is prepared. So 31st March to 18 onwards, 18, 19, 20, 21, 22, 23. 5 years before. Okay. What we have to see, which number of shares were issued as fully paid up shares without payment being received in cash. Or have they given bonus shares in the last 5 years? Have they done buyback in the last 5 years? Okay. So they have to give the number and the class of shares which have been done like that. So if company in the last 5 years, have they given bonus? You know what is bonus shares, right? It is said that bonus shares are free shares, receive free shares. What free shares? They are not free shares. They are reserves of the company which they are converting into equity shares. Okay. So company has got some reserves like CRR, capital redemption reserve. So they convert it into your share capital. So it becomes like from reserves they become share capital. Not that you're really giving, they look like free bonus we're getting free, but it is not free. It is your only reserves given to you in a different form. Okay. So earlier it was in the form of reserves, now it is in the form of share capital. Your number of shares will increase, but your value per share will come down also, because total amount is same only now. Then A point के लिए what example we have is, suppose company has shares issued in amalgamation. Shares issued in amalgamation. So shares issued in amalgamation means what? Now you know when amalgamation happen means two companies are coming together. Okay, so two companies have now merged, or absorption में one company takes over another company. So when one company takes over another company, they have to issue some consideration. Free में तो I'm not taking, I have to give something. So suppose I'm issuing to them equity shares. So I'm issuing equity shares, but I've not got cash for that. I'm getting a whole company for that. So all these kind of things we need to disclose. What we need to disclose? By out of this we have issued so many shares without consideration being received in cash. So here when I was showing you the note now, here when I was showing you this note, here only you will write out of the above. You will write like this. Okay, so for point number I am saying, for point number I, you will write out of the above. Let's say 10,000 shares are issued for consideration other than cash. Are issued for consideration other than cash. Means I did not receive cash. I received something else. So best example for this I told you. It is your amalgamation. So this is what? This I point is this only. What they are saying. Or you have given as bonus. So you have to write that also. Okay? So many shares are issued as bonus. Because it is not, we have not received cash. So we have to give the details. Okay. So this we have to give in our equity share capital. There. Going further. And this we have to give for 5 years. 5 years we need to give this. Okay. Then what are the convertibles? What are the terms of conversion? All that we need to give. See, any securities which are convertible into equity, preference shares, along with the earliest date of conversion in descending order, starting from the farthest such date. So what does this mean? Suppose you're having convertible preference shares, or you're having convertible debentures, anything convertible. So those convertibles you have to show in descending order of their conversion. So what does this descending order mean? I will explain that to you. Again, you can write. I'm giving this example for point number J. So write over there, share capital J. So you have to write in the notes. What you will have to write? That convertible preference shares or convertible debentures are there, or convertible preference shares. So they will have a date of conversion. They will have some date from when it will be, on which date it will be converted. So we have to give the dates. So suppose some are convertible in 2030. Some are convertible in 2030. So we will write convertible 2030. Some are convertible in year 2029. So we will write over here. Some are convertible in 2027. So like this. So this is what the date of conversion. This is what the date of conversion or year of conversion. This. So you have to give it in that form. So it will go in descending order. Means this is how there could be multiple shares. Some may be convertible in 2030, some may be 2027 to 2024, whatever. So which is going to happen first, you will put it last. And which conversion is the latest, the last one, you will put it first. The descending order of conversion, you have to give the notes. This is what they say. Okay, descending order of conversion. Then calls unpaid you have to show. We saw calls in arrears, so it is calls unpaid. And when we say call unpaid, you have to show separately from directors and by others. Like officers and directors which are not paid the calls, you will have to show it separately. And for others, you will show it separately. Okay. Then forfeited shares. You know what are forfeited shares? If someone is not paying the call money, then company can forfeit, means they can take away those shares. Okay, that is called confiscate the shares. So in that case, we will show those forfeited shares under share capital. That is what we will do. Okay, so forfeited shares will be shown here, and it will be shown at the paid up amount. Whatever originally you had received on the shares, you will show it at that amount. Later on, forfeited shares may be reissued, may be cancelled. Okay, reissued, cancellation normally we don't do, we reissue those shares, and then whatever extra profit we have received on that reissue, we transfer it to capital reserve. So all this in CA foundation you have learnt. If you remember, well and good. If you don't remember, when we have problems, when we are going to get these adjustments later on, every single thing again we will revise. Okay. And lastly, you have to also disclose the shareholding of promoters. So the ones who had initiated, formed the company, promoters, you will have to give the shareholders, promoters details. What is a promoter's name? How many shares were held? Percentage of total shares. Did it change during the year? Last year they were holding 10%, now they're holding 9%. Then you have to give that. Who is a promoter as defined under Companies Act? And separately for each class, equity, preference, we have to give the shares. Okay. So all these things we need to give for the share capital. So one share capital, but see how many notes, almost 13 notes. And within that also there could be so much of more information. So this is how much of detailing is required. Okay. So once we complete our A, B, C, just our liabilities, I will show you the notes relating to the liabilities today only. So immediately we can link it. And then later on I will show you relating to assets. So instead of showing it in one go, I will show you in parts. Okay. So I hope you understood how it is shown your share capital. So many details we need to give, right? Now, second one, which is very, very important, reserves and surplus. You mark this. This is the most important one because we need this in like every sum. Okay, so you just star mark this. So after share capital, we have got reserves and surplus. So reserves and surplus mein what we have? So reserves and surplus mein mainly we have got capital reserves and we have got revenue reserves. So capital reserves are the ones which are not available for dividend distribution. So they are like capital profits. It doesn't happen every time. It happens lesser number of times, this kind of capital profits. So that will be coming under capital reserves. And those profits which are regular revenue, business related profits, they are revenue reserves, which are available for dividend. So the main concept is that if it is available for dividend, it is considered revenue reserve. Otherwise, it is capital reserve. So you need to show your reserves under these heads. Okay. So what are the heads of the reserves? First, capital reserve. Capital reserve, which is out of capital profits. Best example for capital reserves. When you are reissuing your forfeited shares, the extra amount you receive after your face value, extra of the profit that you have received, is called your capital profit. It is transferred here. Capital reserve. The profit on reissue of forfeited shares. Okay. Or capital redemption reserve. We call it CRR in short. So when company is doing redemption of preference shares, when company does which are on redemption of preference shares. You had this chapter earlier in your syllabus, but now this has shifted to foundation. Okay, so on redemption of preference shares from profits, whenever you are redeeming preference shares from profits, it is transferred to CRR. This is the requirement of my Companies Act. So that CRR can only be used for giving bonus shares. So this CRR concept also you have to show it in your reserves and surplus. Okay, and you can use it for your. We are going to use this in our buyback chapter. We will have little bit of CRR thing. So we will see that time this point. This will come in our syllabus later. Okay. So CRR is there. Then what is securities premium? So whenever you are issuing shares more than the face value. So 10 rupees face value, but issue price of the share is 40 rupees. So the 30 rupees extra goes to securities premium. Okay, so what entry we pass? 40 rupees when you're issuing the share, we'll say bank account debit 40. I'm getting 40 rupees. To equity share capital always shown on face value 10 rupees. And to securities premium 30 rupees. So the extra amount, this is also a capital profit. You cannot just use securities premium for anything. You have a section 52 of Companies Act which says that securities premium can only be used for certain things. We have that in our notes. We will come to this. Okay. So point is securities premium is also shown under reserves. Then comes DRR, debenture redemption reserve, which is for the redemption of debentures. We have to create. It is required. Again, it is required by the Act only. So DRR, CRR, all that comes under your reserves and surplus. Okay. Revaluation reserve. This we will cover in AS 10. When your property, plant, equipment, your fixed assets are revalued. Okay, so then that revalued means now 10 lakh I'm showing my land. The market value, let's say, has become 25 lakh. I want to show it at 25 lakh. So then I can show it at 25, but that extra 15 lakh, where it will go? It will go to reval reserve. What can you do with reval reserve? You cannot use it for dividend. It is a capital profit. You cannot use it for dividend. Remember that. Okay. So again, what is this? We will be seeing this in our AS10. So reval reserve comes here. In fact, all these are capital profits only. All these, what I'm saying till now, all are capital profits. All capital reserve. Then share option outstanding amount. So these are issued for ESOP, employee stock option plan. What they do in employee stock option plan, when we give employees an option, you can buy shares in our company. This chapter was there again in advanced account. Now it is gone. Okay, but the concept little bit is remaining. Whatever these ESOP outstandings are there, ESOP outstanding means what? The employees have an option to buy shares in my company. So employees have an option to buy shares in my company. So tomorrow I will have to issue shares to them now. So those issue of shares, till the time they buy the shares in my company, I have to create like this ESOP and keep. And once they will exercise the option, then this ESOP will be transferred to our share capital, securities premium. And if they don't exercise the option, then it will be transferred to general reserve. But basically it is your shareholders funds only. Okay. So like I said, this chapter will not come anywhere. This is not going to happen. But we need to understand where is ESOP shown. This can come in your exam or MCQ where it is shown. So ESOP will be shown where? It will be shown under your reserves and surplus. Share option outstanding it is called. Example for this is ESOP. There could be any other options also outstanding for shares, but maximum times we use it for ESOP only. Employee stock option plan, the options outstanding, we show it over here. Okay. And any other reserves could be there. Any other reserves, what could be the example? They could be general reserve. General reserve, you all know now. So general reserve is there. All the other reserves will be coming there. Any other reserve is there. What is the purpose of the reserve and all that? Give the details. Right? And last one, last but not the least, is your surplus. See, we have said reserves and surplus, right? So what comes under reserves we saw, but what is surplus? So surplus is nothing but your balance in the P&L. So P&L account, what balance is there is called your surplus. So earlier now we used to have a P&L appropriation account. P&L appropriation account means what we used to show? We used to show कि P&L may what all things have happened, like how much dividend is paid from that, or what is a transfer to reserves. All the appropriations used to happen in P&L appropriation account. Now there is no P&L appropriation. Now whatever plus minus you do, your allocations, appropriations, all that, like dividend you have given, bonus shares, transfer to reserves, everything will happen in surplus. So you will write the head surplus, under that you will write P&L, whatever. I'll show you how this is given. Okay, you can again write this in your notebook. See, let's see this. Okay, what did we learn? Reserves and surplus. Basically your reserves and surplus. So reserves, what did we have? We have got so many types of reserves we saw, right? We saw capital reserve, we saw capital redemption reserve, correct? Then we saw your securities premium, we saw your DRR, capital reserve, CRR, DRR. Then we had got your revaluation reserve, right? And we had got your shares option outstanding. Out of this, these are definitely capital reserves. These are capital reserves, means capital profits. Revaluation reserve is also a capital profit, capital reserve. Debenture redemption reserve is for debentures, but eventually it gets transferred to general reserve. The end result of that DRR is it gets transferred to general reserve. So we don't consider it like a capital reserve, okay? So these capital reserves, remember, your reserves could be capital or revenue. Revenue reserves. Capital reserves not available for distribution. They are not available for dividend distribution. And revenue reserves are available for distribution. You can dividend distribution. Then you can have general reserve. Okay. So general reserve is a revenue reserve. DRR eventually transferred to general reserve. So that's why I call it like it could be there. And what about share options outstanding? This could become share capital. This could become share capital in the future, right? It could be share capital. It can become, because these are options with the employees. So they can, if they want, convert it into shares. Or it can become securities premium. SC means share capital, okay? So when does this happen? Share capital, securities premium. If option to buy shares is exercised in ESOP. So they will become equity shares or they will become securities premium. if option not exercised, by employee, transferred to general reserve. So we cannot say will this become shared capital or will this become a general reserve. So better not talk whether it is capital, is it revenue or capital. So normally it is not available for dividend. Normally DRR is not available for dividend. But after it gets transferred to general reserve, it can be available. Okay. So this is how it is. And like I said, this was a chapter you had, but now it is not there in your syllabus anymore. Okay. So it is gone from your syllabus now. ESOP. But one or two sums somewhere we will need this. Okay. So that time I'll give you the detailed entries. See, remember now what we are learning is we are just touching on a lot of things now. Getting familiar with the Companies Act, getting familiar with the terms which are used. Not that everything in detail we have discussed now. No. Lot of these things will come back. Securities premium will come back. Revaluation reserve will be coming. Then we will have ESOP little bit adjustments will be coming. We will have CRR will be coming somewhere. So that time we will give you CU points, conceptual understanding points to revise all these things. Right now just understand as much as 80, 85, 90% you understand now, it is enough. 10, 15% is okay if you're not getting everything. It's absolutely normal. You will get it eventually. Okay. Now this is what I have my reserves. Now coming to the surplus, what I have surplus. Now we will see what is surplus. So surplus we have is nothing but your P&L balance will now be called under surplus. So in P&L balance what we will have some opening balance in the P&L. To that we will have less, add the profit, net profit for the year will be added here. Yes, less any appropriations. Appropriations means what? What you are giving out of profits. Less appropriations, what we can have? We can have dividend, which is paid. Or we can also have transfer to reserves. We can transfer to reserves, and this net balance, this balance is shown is surplus. So it is your P&L balance only. Opening plus your profits for the year minus any appropriations, transfers. The closing balance is what is shown here. Okay. Now pay attention. This negative, this balance may be negative. May be negative because companies made a loss. So my opening balance was 10 lakh. This year we made a loss of 25 lakh. So 10 lakh minus loss of 25 lakh, 15 lakh negative. So can it be negative? See, reserves are not normally negative, but P&L can be negative. I said reserves are not normally negative because sometimes reserve also can be negative. We have exceptions. We will learn about this when we do AS 11. Okay, so right now understand ki if the balance in P&L is negative, show negative figure. Show negative amount. No problem. You show the negative amount. You show it. It can happen that my total reserves and surplus also become negative. Possible. Ki my reserves are 5 lakh, but my loss, my P&L balance is minus 12 lakh. So net amount is coming minus 7 lakh. Possible. You will show it. It is to be done. Earlier, long back, before Schedule 3 came now, they used to show negative balance of your P&L as under asset, as P&L debit balance. So normally a layman will not understand that this is negative. They will think asset, profit and loss is lying in asset. A normal person will think this is an asset. But this is a loss. So now they say no, show it under negative figure. So people know ki bhai this is a loss. So this is how now, okay? So this is what reserves and surplus are about. Clear with this? Now, coming back. So as we said, surplus will be shown. All additions, deletions, whatever plus minus has happened in the reserves, you will be showing that also. Any additions, deductions from the balance sheet date, opening balance sheet date, right? Opening balance plus additions minus whatever deductions, reserves, you will show it. If you have a reserve which is represented by year marked investments, it is called a fund. Means what? If you have year marked means for a specific purpose. Write the meaning. Year marked for a specific purpose. So if you are having any reserve which is basically having some investment, like example debenture redemption fund. If you have only reserve, you call it debenture redemption reserve. But if you're having debenture redemption investments, you're having for redeeming the debentures, we call it DRI, that is debenture redemption investments. So if you're having investments for redeeming debentures, then you will call this debenture redemption fund. Don't call it reserve, you call it a fund. It will be shown here only, but you will call it fund because it is already funded with some investments. Means this amount payable, you are having some money ready for that. So you call it a fund whenever it is having some investments against it. Like you had sinking fund, if you remember in your foundation depreciation method. So what happens in sinking fund? You had sinking fund, why I used to call it? Because you had got sinking fund investment in front of it. So that is called a fund. Okay. And last and the very very important point here, star mark point. If there is a debit balance in the P&L, right, means there is a loss, negative amount. Debit balance in the P&L will be shown as a negative figure under surplus. Even if your reserves and surplus, because of this negative balance, is showing negative amount, it will be shown under the head reserves and surplus as a negative amount. Means what? I'm trying to say here. See, let's say for example, you have normal reserves of 10 lakh. Okay. And your surplus means your P&L is having a debit balance of 12 lakh. So negative has become 2 lakh. Now the reserves and surplus will show a 2 lakh negative figure now. Because reserves 10 lakh minus 12 lakh this. So you will show 2 lakh. This will be shown as a negative amount in reserves. So amount, this will be shown negative amount in reserves also under reserves and surplus. Possible. So this is how things are. So this is what they're saying. It can be minus figure and you might be showing it minus here. That's okay. So I hope this is clear. So today we learned only two things. Share capital and reserves. That's all. Okay. More liabilities, more asset related we'll be learning tomorrow. But today I will definitely want to show you the share capital and reserves. What do you say? Notes, actual company. We will just see that to have an idea about it. Okay. But otherwise, this is enough for today. Lot of things we learned. Okay. That's it then. Just give me 2 minutes. We will see the balance sheet now. So now I'm going to show you the annual report of, see the company's name, Infosys. Now this Infosys company report is your 2022-23 report. Infosys is a listed company, we all know. So this report is definitely Ind AS based. So I will not be able to understand the format of the balance sheet P&L here because it is Ind AS company. So what we will do, we will see some companies which are Ind AS companies just for some figures and the way it is presented and maybe notes which are there. We can see some things are common. And then we will see some reports of companies which are AS based, which is applicable for you all. Okay, but because all the big companies, listed companies, interesting information is in this Ind AS base, so little bit we have to use that also. Okay, so now let me show you. This is the report of Infosys. I will zoom it when required. First, let me just see what all is there. So this is your contents you have here about Infosys and all they have given, and then the statutory reports including board report and all that. And where is their financial statements are page 206. It is given over there. So we need to go right over there. See, 358 pages report. Imagine. So we have to see 206. Just for your understanding, I'm showing you. I'm repeating, don't go with the format because this format is not for you all. But to understand, no problem. See, this is the balance sheet. And now just for your understanding sake, again, I'm saying this balance sheet is Ind AS based. So here we show assets first and then equity and liabilities is shown. Okay, see. So, but in our case, in our AS base, equity liabilities is first, then it is assets. Okay. Then they have SOPL, statement of P&L. Statement of P&L format is somewhat similar. Okay, we will see that later. This is how they have to show their reserves. Capital reserve, CRR. Can you see the column? Securities premium. Only what we understand, that much we will see. General reserve column, share options outstanding. So they have all that. And there they will be showing what is the opening balance, what are the changes during the year. They have to give all that. Okay, just for understanding I'm giving you this. Then this is the SOC. Remember I told you that these Ind AS companies also have to make statement of changes in equity. Changes in equity means equity, share capital and reserves. So what all has happened during the year, that changes they have to give here. So that is given. See, for share capital, see the columns you'll understand. Share capital, capital reserve, CRR, all those reserves and everything. What all changes have happened during the year, they are giving that. Okay. But this is not what we wanted to see. This is the cash flow statement. Again, this is not what we wanted to see. So we have got share capital note we wanted to see, correct? So we will see. Their share capital note will be coming later because they show assets first. Now, so the asset notes comes first. Investment notes, loans given, all those things, cash and cash equivalents, everything comes here. Okay. Okay. Now here comes your liabilities. No, not yet. Yes. Here is your liabilities, equity. Did you see? Share option outstanding, CRR, share capital they have given, authorized, CR. Authorized, issued and paid up you have here, right or no? Rupees 5 par value you have to give now. Face value 5 rupees it is. How many equity shares they are having? Rupees in crores, huh? This is now 2,400 crore rupees. So how many crores? 3, 4, 5, 7. 480 crore rupee shares of rupees 5 each. Issued, subscribed and paid up is given. So many shares are fully paid. Forfeited shares also down they have given. Can you see? Forfeited shares amounting to 1,500. So like this, all this we saw na today. So they gave all this. Then in the period of 5 years preceding 31st March 23, 5 years, they have given bonus shares, they have given buyback. All the things are given over here. I hope you are able to see it, or should I zoom it more? See, bonus shares and all that. Then buyback, what all they have done, they have given that. Shareholding of promoters. See the promoters. how many shares they are holding, they have to give now percentage of shares changed during the year. So you can see the names of the promoters. Narayan Murthy is only holding 0.4% shares, if you will see, right? So this is what they have given over here about CRR, other reserves, dividend, etc. Who are the people holding more than 5% shares? See, here we have that also. Details of the shareholders holding more than 5% shares. So we are having Deutsche Bank Trust Company holding 12% shares and Life Insurance Corporation 7. Only 2%, only two people are holding more than 5%. Even Narayan Murthy is not holding more than 5. But as a promoter, you will see promoter shareholdings are given over here. So this is what we were saying, 5%. Then reconciliation of what were the number of shares in the beginning. Plus now see, shares issued on exercise of ESOP. So when employees exercise the option, they bought shares in a company. So then that add less buyback, you will get the net number of closing shares which are there. Then they have given about ESOP, details about ESOP they have given. And reserves, so already I showed you a bit about the reserves also, etc. So your equity share related things. This is not completely which you'll understand, but little bit I'm sure you got the point on like how the things are shown. Okay. So that's it then for today. So then tomorrow we'll continue and tomorrow we'll be doing the other items and whatever we have learned today, revise it properly. That's it for today. See you tomorrow. Bye bye and always keep smiling.